All right, good morning, everyone, and welcome back to, oops, I think the music is playing double on my screen. So yeah, good morning, everyone, Jim. Welcome back to another episode of Powered by 0x. Really good to see you all back again. I know it's been a couple of weeks since we've had an episode. So excited to have a really special episode today that's focused on MEV. So colloquially, minor extractable value, or what's transitioning more to maximal extractable value. And so today we'll have some notable guests from the space who are working on projects that are addressing MEV at different levels. So whether that's in research or building tools to mitigate the negative risks of MEV. And so the show will be covering just an overview of what MEV is for those who are less aware, and then transitioning more into why are we looking at it, and then what are the different solutions that are out there. And so to set the stage for like why MEV is, why we're even talking about this. Well, so since 2020, MEV bots have actually extracted over $650 million from DEX users, and that's quite a large number. And these losses typically don't actually show up. Well, actually, they don't go reported, and they affect end users often without them really knowing. This number is not saying what it is. Sorry, I just got a little ping from internal group. Maybe they can come up and add some color to that numbering there. But essentially, it's a really big concern that's going around, especially the negative portions of it. And a naive definition of MEV is that it's the amount of profit that a miner or a validator, as we're moving from proof of work to proof of stake, that a validator can make by arbitrarily including or excluding or even reordering transactions in the way that they're producing these blocks. So let's definitely dive into this, as we're exploring this topic. So I'm going to bring up our guests. So we have a full table today. So I'm going to welcome them onto the screen here. All right, it's a stacked panel. So hey, everyone. How's it going?
Hello.
Hello, good morning. Hey. Hey. All right, so I know with so many people on the table today, I'd love to go around, do introductions. So if you could, give your name, what project you're working on, and then maybe you start off with like, how would you describe MEV to a beginner? So yeah, what is your introduction for that? So any brave souls wanting to do the first intro today? If not, I will pick names.
All right, I can go.
Okay.
Given it's powered by 0x stream, I feel like I should probably step up and introduce myself. So yeah, hi, I'm Will Warren. I'm one of the co-founders of 0x Labs, and yeah, we're working on building products such as 0x API for developers, which we recently rolled out slippage protection, which is a way of addressing MEV, and yeah, we're also developing our consumer product, matcha.xyz, which is a DEX aggregator. And really excited to have this amazing panel together.
Cool, I can be next. Hi, I'm Hasu, I'm strategy lead at Flashbots. I also work with Lido and a couple other protocols. And my take on MEV would be, MEV is money that miners, based on their privileged position in the network, can make from censoring, reordering, or including transactions of users or their own in Ethereum blocks. So MEV is a system, is a sort of an emergent property of any system that has some actors in a privileged position. Right? So MEV doesn't, it's typically associated, and the name was coined in the context of Ethereum and DeFi and so on. But MEV also exists, for example, on centralized exchanges, where it's long been theorized that, for example, exchanges can front run their users or liquidate them, or basically do anything that's sort of a result of their centralized position. And many banks, for example, have been already penalized many times for front running their users in dark pools and so on. And MEV is really just that phenomenon ported to DeFi. And so anything that is extracted by miners is basically something that first has to be exposed by users. And so users typically have a transaction that expresses something that they want to do on the blockchain. But very often they are not precise or defensive enough in how they express this intent. For example, a user that only says, I want to buy this token on Uniswap, they might make a mistake in specifying what is the worst possible price that they are willing to accept. And then when a miner sees this transaction, or typically today, MEV is extracted by specialized parties on behalf of miners, then what happens is that the miner sees this transaction and sees, oh, this is the maximum that I can extract from this transaction, or that's sort of the minimum price that the user is willing to buy this token for on Uniswap. And so let me just mess with the order of transactions in a sense, in a way that so this user basically gets the minimum tokens that they were willing to accept, and that transaction is still valid, and I take the rest for myself. And so you see, really, it's a sort of a two-sided game. It's users making transactions that express a certain intent and that sort of leak MEV, as we would say, and then miners in looking at this opportunity and sort of messing with the order of transactions in order to extract it.
Cool. Yeah, thanks for that summary, Hasu. So how about, anyone else want to go next? Maybe I'll pass it over to
Happy to go next.
Yes, thanks, Bert.
So I'm Robert Miller. I lead product at Flashbots. Would be happy to give my take on MEV, but it would just be repeating a lot of things that Hasu just said. So I will defer to the next person for their take.
Yeah, no worries. Yeah, let's keep our answers for this round just a brief, 2-3 sentences. We'll definitely dive more into detail later through the talk. So about Felix.
Cool. Yeah, I'm Felix. I'm the technical lead for Cow Protocol. Cow Protocol is the underlying protocol behind CowSwap, which is a trading UI similar to Uniswap, Matcha, 1inch, that tries to address MEV at the application layer by batching people together into a single, basically batching multiple trades together and trying to only have a single clearing price per asset per batch, because we think that that's where most of the fundamental MEV, at least the DEX trading, comes from. And if I had to explain MEV to a newbie, and hats off to our front-end lead who came up with this metaphor, it's like when your friend asks you to go to the store and bring him a newspaper with you, and he gives you $10 for it, but the newspaper is only $6. Yet at the end of the day, you won't get any change back. That's what happens when you do a trade with slippage tolerance on Ethereum.
Good analogy. How about who's next? Tarun, want to go next?
Sure. Yeah, so I'm Tarun. I'm sort of founder of a company called Gauntlet. We do sort of parameter optimization, and in the process of doing that, we spend a lot of time analyzing MEV transactions. I would say there's not much to really add to what anyone else has said, other than I think the set of MEV strategies over the next coming year or two will probably grow dramatically due to cross-chain interactions and sort of some of the changes coming to Ethereum.
Makes sense. And then Robert?
I'm Robert. I do data at 0x. I spent my time staring at the chain and trying to figure out what's going on. Yeah, I think Hasu said everything that needed to be said. I think of it a bit like MEV is a fine print. There's an intent and there's the fine print that the user doesn't read. and all the bad stuff that can happen is written in a fine print, and sometimes it happens, sometimes it doesn't, but it's hidden in there. Like people are not aware of what can happen to them.
Yeah.
Oh yeah, sorry.
I was saying, Hasu, you had a comment.
Yeah, I was going to say before we end the introduction on MEV, there's one more thing that I would add that I think is really important, and I think we're going to talk about it later on, which is that MEV is like we now have all the perspectives why MEV is bad for the user, but MEV is also bad for the economic security of the underlying blockchain, and that is because MEV sort of makes mining or staking very complicated. It leads to different validators, different node operators earning very different returns on their investment, and it can create incentives for censorship and for reorganizing the blockchain, and it generally destabilizes the blockchain. And so MEV is something that is very clear that we want to minimize it on behalf of the user, but it's also clear we want to minimize it on behalf of the overall network. And I think I think this frames a lot of the future discussions, because we have very different approaches to dealing with MEV here. And all of us have kind of the same goals of minimizing MEV in the long term, but kind of different approaches of how we want to go there. That sort of some approaches basically prioritize the health of the network in the short term, and some prioritize the health of the user in the short term. And so I think if you listen to this debate now going forward, I think this is the framing that I would keep in mind to sort of understand how all of the different approaches that you'll hear about today for MEV minimization and so on are going to fit together.
Yeah, good framing for that. So then maybe to get us started off, just diving into the content, I'd like Will to just do a quick presentation on transaction sequencing, and then talking about the different layers of the DEX stack, so that we have a framework when going through this conversation. So Will, do you have the slides, or should I share it?
Would you mind sharing it? Or yeah,
I can share
that'd be great.
Sounds good.
Thank you, Jessica.
Yeah.
And yeah, so I definitely don't want to like steal a spotlight, want to spend as much time talking to the guests as possible. Just want to like provide a little bit of context and like a few prerequisites, just so everyone understands MEV in the context of like the Ethereum fee network and the fee market. And then also like, how do we kind of like define the decentralized exchange stack? Like, what are the different layers of the stack, and how does MEV manifest, or how can it be addressed at those different layers? The Ethereum network has a limited amount of block space in which transactions can be placed into a block, and before transactions are mined into a block on the Ethereum blockchain and kind of finalized, they sit in what's called the pending transaction pool, or the MEM pool, and they are essentially waiting in line to get to the front of the line, and then eventually a miner will select these transactions that are paying the kind of highest gas price and put them into the block, because that's kind of the economically efficient thing to do to maximize their fee revenue. And there's a really great tool called transactionstreet.com. I think the link's in the bottom left there. I think it's like a really great visual aid that helps get a conceptual understanding of how the Ethereum pending transaction pool and fee market works, where essentially, each block can be thought of as like a bus with a limited number of seats, or a limited number of space, or a limited amount of space. And the miner gets to choose, who gets to go onto the bus. And the miner changes every single block. And the way that, given that the fee market works in such that users that are paying a higher price per unit of gas get prioritized, at least by default, users are incentivized to kind of like bid up the amount of gas, or the gas price they're willing to pay for their transaction to be included, so that they can jump to the front of the line. And so, if you have a transaction, you really need to make sure that your transaction is mined in the next 1 or 2 blocks. Then you're going to look at all of the other transactions in the pending transaction pool. You're going to see the gas price that all of those transactions are offering, and you're going to, specify your own gas price such that it puts you kind of towards the front of the line. And it's important to note that the pending transaction pool is completely publicly viewable. So everyone, that's connected to the network can see all of the pending transactions. They can see what those transactions are intending to do. And this, not only allows you to kind of set a gas price that will get your transaction mined earlier, but it also allows kind of malicious actors or just, I guess, economic actors to, respond or react to these transactions that are waiting to be mined. And this, this results in what are called kind of priority gas auctions, where, if there is an opportunity to capture some value, some MEV in a risk-free way, say you can make $100 of kind of risk-free profit if you are able to kind of get your transaction mined first, well, then different actors can compete for that MEV, and they can kind of bid up the gas price in a priority gas auction such that their transaction is mined first. And what happens is that if there is, say, like a $100 risk-free arbitrage opportunity, then, theoretically an MEV bot should be willing to pay what, an amount of transaction fees that approaches $100. And so that's just kind of an overview of how the Ethereum fee market works and how transaction sequencing works by default. But it's important to note that the miner does not have to sequence transactions according to gas price. They have kind of like God mode, and they can sequence transactions in whatever kind of arbitrary order that they prefer. They can also mine an empty block with 0 transactions. It wouldn't be economically sound to do that, but it is something that they can do. So they have like a high degree of control. Next slide.
Be stuck. Sorry, seems to be stuck.
No worries, I can go off memory. So when we talk about the decentralized exchange stack, it consists of different layers, and the way that we define it is that there's 3 layers. There's the application layer that sits on top, and this is where users are kind of directly interacting with an application. It could, like a front-end application like Uniswap, the Uniswap app, or CowSwap, or Matcha, and they're oh, here we go. It also includes wallets, so MetaMask, Coinbase Wallet, all the others. There's kind of like the trade execution layer, and so the trade execution layer is where kind of the sequencing of transactions can be controlled, and so we have we have like a number of different ways of implementing trade execution, and most according to our definition, most of the solutions to MEV that we'll talk about today, at least we kind of categorize them as sitting at the trade execution layer. So with CowSwap, we're batching many transactions together, and before submitting that batch to the blockchain, that is the trade execution piece. And then there is the settlement layer, which sits at the bottom. And the settlement is when assets are actually being moved between counterparties on chain. So kind of like the smart contract layer. And so this is kind of how we define the DEX stack. And just kind of using this as a reference so that we're all using the same terminology.
Cool. Thanks for the introduction, Will. So with that, let's start diving into the questions. So to get us talking about like the different players in the space. So you talk about the different sequencing and you mentioned the miners and the retail users. So there's this concept that I heard from Flashbots about the MEV supply chain. Would one of you, maybe Hasu, like to take that one? Talk about, essentially what is this supply chain that we're talking about?
Yeah, sure. I mean, Will already touched on a lot of it. I think it's just conceptualizing the way that any transaction takes from the user intent all the way before it gets confirmed on chain, and visualizing it as a sort of supply chain, different phases that the transactioners go through. It allows us to reason and analyze the different steps individually and see where things go right and where they go wrong, and also where risks for the underlying blockchain can emerge. So very simply speaking, so the user, when they want to trade, if you want to trade on Ethereum, then you have an intent, something you want to do that's in your head, and then you turn it into action. You go to Matcha or you go to any other application, and you say, basically you tell the UI what you want to do, and then the UI, it crafts what we call the transaction payload. And this payload has all of the technical information about what your transaction actually wants to do. And then many times, like in my early introduction, I said that very often sort of the actual transaction doesn't do exactly what the user wants to do, what's their intent. And that delta between the two, that is the MEV. And Felix's example also fit that perfectly, by the way. So if you, as a user, you broadcast your transaction to the network, it goes into the public mempool. The mempool is the waiting area for transactions. And that's where searchers, they are kind of agents of the miners who, on their behalf, sort of reorder the transactions into blocks. Can see a transaction and sort of use it to sort of reorder this transaction or add their own transactions in order to maximally extract it. And sort of the most nefarious one and sort of the most well-known one would be the sandwich attack, where the searcher sees that the user is willing to pay a certain price. In Felix's example, that sort of you're willing to buy the newspaper for $10, and although in the store it actually only costs $6, and then sort of they take your $10 to the store and buy the thing for $6 and keep $4 for themselves, practically speaking. And and so these searchers, they typically submit their transactions to something that we call a builder. In proof of work Ethereum, that's a mining pool, and in proof of stake, they will just be called builders. And then these builders, basically, they determine what the final block ordering looks like, and they go to the miner or to the validator and say, I want to buy all of your block space. And that's sort of how the entire route that a user transaction takes, all the way from their intent all the way to inclusion on chain. And we can see sort of in the stage where it goes in the public mempool and it is seen by a searcher, this is very clearly the point where the user takes the financial loss, right? Where the MEV leaks to the searcher, who then pays it forward to the miner. And I think that's why a lot of approaches basically focus on, replacing the step, right? Where a user basically doesn't broadcast, for example, their transaction privately, or where we layer on additional guarantees. So Flashbots Protect, for example, that we touched on, is an example of where you can get pre-trade privacy if you submit your transactions through that. But for example, CowSwap has the approach of layering on an additional sort of rule that the transactions have to abide by, namely that this transaction has to have the same clearing price as all other transactions of the same type in the same block. And so that's called a batch auction. And so really there are like a lot of different approaches to minimizing the MEV at this stage. And so that's what we're going to hear about, hopefully.
Thanks for that explanation. So the next question would be the relationship between MEV and slippage. How does MEV, how does it actually manifest on the user's side? Could maybe Robert talk about that? Do you want to take that one?
Yeah, happy to talk about it.
Okay.
Oh, interesting. Why don't you talk about it, Robert? I know you've done data science on this, so go ahead.
Yeah. I mean, overall, I think quite a lot of MEV the users don't see because it doesn't influence their price or the price they see. But there's also a part of it that makes users get the worst price. So how the usual flow looks like: a user goes to his favorite DEX aggregator. He says, I want to sell token X, buy token Y, inputs the amount, gets a route, and clicks submit. And then this transaction enters the mempool, some things happen, and he gets less tokens than expected. And this is the slippage. Do not confuse it with price impact. And this is the worst kind of MEV, because this actually causes users to lose money. And this is something that people designing customer-facing applications should really think about, how this can be thought of. And basically, the function that should be optimized is not the quoted price, but the realized price. And you should keep that in mind, that bad things can happen. And maybe later we can discuss a bit how we approach this. Right, so it's a difference between what you see in the UI and what you actually get. And this can happen to be quite large.
So I've got a follow-up question. I'd be interested. So you're talking about the case where a user is quoted a price in the UI, but they set a minimum amount out that's much lower, and they get sandwiched, they get a worse price, right? But there's the reverse can happen too, where you make a trade and someone adds liquidity before your trade. It gives you a better price. So I'm curious, like, very specific question here. You have an API for slippage protection, and as I understand it, it tries to like smartly route trades across different liquidity pools where you've like statistically seen slippage happen. And does this take into account just-in-time liquidity too, or do you only take into account the other way?
No, it doesn't. I think it's actually pretty rare, because it requires very particular market conditions. So the trade needs to move the price enough so you can offset the impermanent loss in another place. So we don't do that, and it would be interesting to actually try doing something with this. But I saw the talk that Dan had recently. That's a very rare thing. While I think 40%, that was his number, of transactions on Uniswap get worse price than a block before. I mean, people are losing millions of dollars a month only on that. So, I mean, my understanding is that the bad part is much worse than the good part. We can also see in our data, like, there is positive slippage. It happens from time to time, and there is negative slippage, and it's orders of magnitudes larger. So yeah, this is the sad reality of trading.
Yeah, not contesting that like more money is lost than more money is gained, but rather just interested if you're taking just-in-time liquidity into your algorithm in any way.
So not explicitly, but just-in-time liquidity. So just-in-time liquidity is the idea that right before someone's trade on, say, like Uniswap, they send out a transaction, they want to go and do this trade. Someone else sees that this trade is about to occur, and they deposit additional liquidity into Uniswap, such that the trade is, eating into the liquidity that was placed into Uniswap right when that trade is about to occur. And that means that the user ends up getting like a better price than they were anticipating based on what was displayed in the user interface. And so that would be an example of like positive slippage, or at least it would be, that would be like a positive slippage instance. And so what this plot here shows is this is empirical data collected from 0x API trades, and it shows the slippage. So it's essentially the difference between the price that is shown in the user interface and the price that the user actually gets in their wallet. Once their transaction hits the blockchain, it's the amount of tokens they get in their wallet. So what's the difference between what they were kind of shown in the UI and what did they actually get once their transaction hit the blockchain? And so positive slippage is a good thing. It's the user is getting kind of more than they were advertised. And what we can see is that there's a big spike around zero slippage, because in most cases, users are going to end up getting approximately what was shown in the user interface. But there are also, many trades that end up resulting in a better price than was expected. But we also see, based on this distribution, that negative slippage occurs much, much, much more frequently than positive slippage. And so, yeah, Robert, to answer your question, slippage protection is looking at these distributions and their statistical properties. And just-in-time liquidity, which results in positive slippage, and sandwich attacks, which result in negative slippage, and just kind of like random accidental collisions that create, a random distribution around zero. All of that is taken into account in slippage protections routing. But yeah, we aren't specifically targeting, just-in-time liquidity or sandwich attacks. It's all of that's kind of captured in this heuristic and this distribution. If that makes sense.
Yeah, very clear. Thanks.
Cool. Good question, Bert. So then with that, since we kind of have transitioned into, you mentioned slippage protection as a possible solution that 0x Labs is working on, let's talk about the different solutions that the different teams are working on. So how about turn it over to CowSwap to talk about batching? So can you explain to us like what is this process, like why focus on this mode?
Yeah. So why focus on this mode, maybe to answer this first, is because we think that the root cause for most of MEV, for most of DEX MEV on chain, is the fact that within the same block, we have multiple trades on the same token pair, all resulting in a different execution price based on ordering. And the idea that a block happens kind of in one atomic instant, all the transactions that are mined within a block are mined at the exact very same moment, kind of makes it a little bit bizarre that there's this concept of, well, time priority within a block. So intra-block time priority. And so the approach that we're taking is saying, well, everything that happens within a block happens at the same instant, at the same time. There's no time priority and first come, first serve. It's just an arbitrary concept within a block. So let's give everyone the same uniform clearing price, and let's have every asset just have a single price per block. And the way that this is achieved, Hasu mentioned in his explanation that what everything starts with is the user intent. What does the user want to do? The user want to swap one asset for another. And on CowSwap, the user actually doesn't craft an on-chain transaction, but they just sign their trade intent with an off-chain signature saying that I want to swap token A for token B, some deadline at that limit price. And then this intent is handed over to a order book API, which collects multiple of these user intents and periodically cuts what we call batches. So currently every 30 seconds, there's basically a batch distributed now to a network of parties that receive all the orders that are cut in this very single batch. And those parties now try to find the best solution for matching all the orders that have been submitted in the batch. And what does that mean? It can really mean, because there's multiple trades in a single batch, we can first of all start matching people peer-to-peer. Somebody wants to sell Ether for DAI and somebody wants to buy Ether for DAI. There's no need to hit Uniswap or an AMM or a market maker. In any case, we can just match those people peer-to-peer. Those kind of coincidences of wants, if you want the exact opposite of what we want, is the reason why the protocol is called Cow protocol, coincidence of want protocol. And it really is the reason why we can offer structurally better prices than some other DEXs and market makers and other protocols. Because when there is a coincidence of wants, you are saving, first of all, on the liquidity provision fee that you usually have to pay to Uniswap or whatever AMM you're using. Even if it's a market maker, they're taking a spread. You can basically mid directly at the spot price. You don't have the bid-ask spread. You also don't have this price impact that Robert was alluding to earlier. If you make a big trade, you might be moving a price up. And if another person makes a big trade in the opposite direction, they might be moving the price down. If there's a coincidence of want, there's no moving up and down in the same block. We just meet at the spot price and save on price impact. And then the last thing that happens in a coincidence of want is we save on gas, because settling multiple trades in a single Ethereum transaction is more gas efficient than settling, let's say, 5 trades in 5 separate transactions, just because of the math that's happening on chain, the state updates, and all that stuff is much more efficient if done in aggregation. And so, yeah, basically, this is kind of the logic or the idea behind why we can offer better prices. The MEV protection also actually applies in the case when the batch only contains 1 order. Because the system works in a way that these batches are dispatched to this network of what we call solvers, the parties that try to find the best solution. They can be compared a little bit to searchers, maybe in the Flashbots model, is that they look at what's available and try to find the best execution for this trade on chain. But the difference is that in Flashbots, really, the idea is to capture the difference between your limit price and the on-chain achievable price and take this as a reward for first the searcher, but in most part the miner. And in Cow Protocol, the idea is that you capture this amount and pay it directly back to the user. So the solver that can actually give the user the best execution price, the best price improvement on their hard limit, where this slippage is maximally returned back to the user, is the one that ultimately wins the right to execute the user's trade. And so in a sense, we have this decentralized competition for order flow, where the user is really guaranteed to get their best execution submitted at the end of the trade. And really the reason why this is also MEV protected is because the actual on-chain execution risk, the MEV risk of getting sandwiched or incurring slippage, is taken by that third party, by that solver. So there's this off-chain competition where the solvers compete for the best price that the user can get. And whoever solver wins that competition is locked into that price. So they have guaranteed that price to the user gets that price, no MEV risk to the user. All the remaining execution risk of doing business on chain is done to the solvers. And we see and think that solvers have a much better understanding of how to execute transactions and are much better than that than the average MetaMask user, for example.
Thanks for the overview. There's definitely a lot of questions, even from the panelists, happening in the back. So we'll aggregate these questions so we can go through the agenda first, but definitely some juicy questions coming up. So next solution I want to talk about is the idea of the proposed separation of Flows builder separation that is coming in when we transition over to proof of stake. So Tarun, do you want to take that one? So what does this model mean and how could it help with the mission?
Yeah, sure. I'll try to give a sort of simplified version of the world. But the idea is that, excuse me, block producers right now sort of have control over both the following operations. First, transaction selection, so which sets of transactions are going to make it into a block. Second, transaction ordering, which we've kind of talked about. And third, sort of the actual execution of the transactions and responsibility of executing those transactions. So the proposer builder separation aims to separate at the very least the first 2 operations of selecting transactions and ordering transactions from the actual work of executing them. In some ways, you can argue that Flashbots already sort of does this, in the sense that if you're selling the rights to ordering in the sort of combinatorial auction, then it's not that different than doing sort of this. It's just that it's not enshrined at the protocol level. It's done sort of externally, which means that sort of you have the centralized auction like Flashbots that then submits these bundles, versus something that could theoretically be done by any validator, or at the very least is able to provide some excess revenue to validators, potentially. I wouldn't say we're at a point where it's guaranteed that any of the mechanisms for revenue sharing are actually going to totally work. But yeah, at a very high level, it's just basically enshrining a lot of what Flashbots does in a way that anyone could kind of participate. And I would say, the design is not 100% full, but the portion that is frozen is sort of the MEV boost portion, and I think Hasu and Robert can definitely talk about that.
Yeah, I can also say something briefly about PBS, since it's sort of Flashbots is developing Mev Boost, which is kind of a light version of PBS that's available today. So I think it's important to frame PBS is not an MEV mitigation in any sense, right? So that's why in the beginning I tried to say that MEV is important from two angles. For one, it's costing users money because the users get front run, etc., and they sort of get pushed to their worst execution price. But it's also bad for the system. Why? Because some validators can be much better at others at extracting that MEV, and that's a centralizing force in the network. And the second problem is exclusively what PBS addresses. So PBS is additive to sort of the MEV approach that Ethereum takes and the whole space takes, and it should be combined with actual MEV minimization approaches like zero access RFQ orders and CowSwap solver competition, which are actually very, very similar in nature. And yeah, I think both have kind of absolutely the right approach to MEV minimization. So Mev Boost is like at a lower layer. It's catching all of the MEV that the higher layers didn't manage to successfully minimize. And it makes sure that the Ethereum system doesn't break as a result.
Actually, either Hasu or Bert from Flashbots, would you like to take a little bit about explaining Flashbots? I know we kind of just transitioned over. Like, what is Flashbots? What is their solution? You mentioned, I think, Flashbots Protect or Mev Boost. Can you explain about the different solutions you're looking into?
You want to do it, Hasu, or I can? So Flashbots is a research and development organization that was formed and focuses exclusively on MEV. So we both do long-term research that is unmoored from short-term product priorities, and we develop products in the overall ecosystem. So some of the products that you might know are Flashbots Protect, which is an RPC endpoint that anyone can use by going to rpc.flashbots.net, plug it into your MetaMask, and this will send your transactions directly to miners today, in the future directly to builders, which will then make their way to validators. And the main benefit of that is you get front-running protection and some other interesting kind of transaction execution benefits that will layer on in the future. So that's Flashbots Protect, helping people get front-running protection. We're also developing Mev Boost, which is this neutral marketplace that was just referenced that splits the roles of the party that's proposing a block from the party that is building a block. And as Hasu was laying out, is important for the long-term economic security of the network and to keep MEV open and permissionless. We have some other interesting products in this space that I hope to be talking about soon. And I also want to call out Flashbots Research, funds all sorts of research into the MEV space. So things like research into the ethics of MEV, fair ordering, into threshold encryption, all batch auctions, better DApp design, all sorts of things long-term oriented. So if you're interested in working on research any of those problems, then feel free to reach out to us. And that's a little bit about Flashbots Research and Flashbots the org.
Sounds good. And there was a related question that came in from the audience. So Danning asked a question for Flashbots. So is there a concern then that the builder and the proposer could have the same priority and they could potentially prioritize for their own MEV benefit?
So I think it's an interesting question. I'll take it first, and Hasu, if you have anything to add, feel free to jump on after. So I think the system is designed such that even if a proposer also wants to be a builder, they have an incentive to participate in this open marketplace. So if a proposer is creating blocks, then they can be a builder for when other validators are proposers for blocks. And they can make some delta of profit by having other proposers include their blocks on the network. So first, other proposers get access to their MEV by having this open marketplace. And second, that proposer as a builder may have a block that has a certain profit, but they also want to switch on the blocks that other builders can create to choose what is more profitable. So the economics are such that you have an incentive to participate in this marketplace on both sides, either as a builder or a proposer. And I think that's required for the system to work. What I will say, the part that is not clear is whether or not there are any latency advantages from being both parties. And I think that's not very well understood thus far. And to be specific about that, you have to create a block within a certain period of time, and you need to sign that block and propagate it to the network within a certain period of time. And by being able to spend a little bit more time creating the most profitable block, is there, because you're co-located as the builder and proposer, is there like some marginal benefit that you can gain that is centralizing over time? That's what comes to mind when I read your question. I'm not really sure what the answer is either way, and needs to be further researched. Hasu, anything to add?
No, that was great. I guess I'd add one tiny thing. There's probably some mitigation mechanisms that will probably not be in V0 for such a thing. I think most of the mitigation mechanisms involve kind of ensuring that you have sort of the right type of randomness on both sides, and such that the sampling and the probability of sampling a proposer and builder that are the same, even if they're Sybils, is relatively low. There's a couple ways to do that. Part of that has to do with like how much stake you're willing to put on both sides, and by sort of forcing that the expected value is worse when you split across the two, by adjusting the fees, the revenue split. So there are ways to mitigate it that I think are not sort of, we still have a lot of open research questions on that.
Good point. So then now let's pass it over to the next solution discussion involving better routing options, and then also RFQ. I think Robert had some thoughts on this one. Well, Robert from Xerox.
Yeah, I think that it's important to realize that most of the MEV is actually it's created by the traders, and the average. Correct me if it's not the most, but quite a lot of it. And the thing is, when the average person comes to Matcha or somewhere wants to make a trade, they use our router to get this crafted and tailored order. And they don't think that, okay, I get 50% of Uniswap, so my price impact is X, it's too high, I'm gonna get sandwiched. Users are not that sophisticated. So I think that the parties that create the orders, which actually do the routing, and we have experts on routing here, have a big responsibility. And the thing is, like, when we prepare a route, we basically know if it's good or bad, if something bad is going to happen, and we should be able to react to that. And when we propose a route that can get sandwiched, we should probably reroute and go somewhere else, even if the expected price is worse, just to avoid that sandwich, because if it can happen, it will happen. So the solutions can be found on the side of routing. You shouldn't just propose trades that can be sandwiched or that cause arbitrage opportunities. And I think a lot of research has been done and will be done on that, because again, like, when we do the routing, we know what's going to happen. Like, we know the state of the blockchain, we know what the liquidities are at various places. And if we give the user the transaction that can be sandwiched, it's not great, and this should be mitigated. And I think we can basically make the sandwiches go or almost go away.
Nice.
And okay, yeah. Sorry. A part of the solution also is that maybe Will wants to say something about RFQ. What is it? How it works? He kind of the father of this.
Yeah, I mean, I'm happy to give a high-level overview of request for quote systems. Yeah, and there's not too much to it, really. Like, request for quote systems have existed for a really long time outside of decentralized markets. And a request for quote system, there's many different types, but yeah, essentially you are at the very moment that a user is asking for a price because they want to complete a trade, a bunch of different professional market makers are pinged, and they're asked what price they are willing to offer for the user for the given trade. And this all happens like just in time, in like less than 100 milliseconds. And so the user is requesting a quote, they get a bunch of Xerox API or like whatever system you happen to be using, collects all of these different quotes, and then will return the best one to the user. And the quote is locked in say, there is no room for slippage, and the reason why it can work really well sometimes is that the turnaround time between when the user asks for a price and when they get it from a market maker is very it's very rapid.
Cool. So kind of two quick related questions from the audience. Gaurav asks, is slippage protection then enabled for all token pairs right now, or only stable and native tokens?
Yeah. So right. Probably worth providing just a little bit of context on slippage protection. And yeah, I know there were a couple of questions from the panel too earlier about it. So yeah, slippage protection will essentially look at historical data of slippage, and it'll look at parameters such as like the trading pair, the trade size, and it will essentially infer the probability or the level of vulnerability to sandwich attacks or to MEV, front running, and it will factor this into the smart order routing. So if a particular liquidity source is, very likely to reduce in to result in slippage, that slippage will be, factored into the order routing. And so to answer the question, yeah, the largest trading pairs are the ones where there's the most data, and we have this, the highest level of confidence in, the slippage statistics. And for longer tail assets or longer tail markets, there's just less data to work with, and basically want to have like a higher level of confidence in our slippage predictions before moving that into production.
That's good. I think you also kind of covered his second question there. So then with that, so we just covered a couple of different solutions at the trade execution and routing level. So maybe let's move down to talking about some protocol level solutions. So I think Felix, maybe Tarun had some thoughts on various commit, order, reveal. This is such a long description for it. So things like distributed key generations. And maybe, would you like to talk a little bit about the solutions that are happening here?
Sure. I can talk maybe about the high level idea, and then
Yeah.
hand it over to Tarun to talk a bit more about the specific technical implementations of it. I think the idea is kind of complementary to PBS, I would say, as a whole, although it could also be implemented as a specific builder policy. But basically, the idea is to decouple the transaction ordering from the content relevation of a specific transaction. So today, when we send a transaction to the mempool, we tell the miner kind of, here's my transaction, here's what I want to do, before the miner says, this is the ordering in which I will execute these transactions. And kind of the idea of that general theme, and there's different implementations of it, is to let the miner know that you want to execute a transaction and maybe say like, okay, here's kind of the gas limit, the rough size of my transaction, how much block space I want for this. And then have the miner confirm to you, okay, I'm going to include you at this block in this index. And I don't know anything about your transaction yet, so I can't really extract any value. I'm not sure what you're doing there. And then only once you get that commit on the ordering, there would be a way to reveal the content of the transaction. Only then the miner would know, oh, I could have actually inserted that transaction there, but now I've already committed to the ordering, so I cannot change it anymore.
Is this is like a commit reveal scheme kind of, Felix?
I mean, I think so. We've mentioned before like two different implementations of it specifically. So one would be so commit reveal. Of course, is like one way to do it. I think the problem with commit reveal is the possibility that the the transaction author would withhold the actual transaction data, and therefore then potentially it's not clear if there's this Byzantine problem that if the builder says, well, I haven't received the payload of the transaction, so I can't include it, you can't really tell whose fault it is. You don't know if the user has not sent the data, or you don't know if the builder has withheld it. So the idea would be to have a trustless system. And I think the most two prominent ones that are being discussed is DKG, so a distributed key generation. And you could reuse the validator set of Ethereum 2 for that distributed group of people that hold a key. And basically, you encrypt your transaction with some key, with some public key that is known ahead of time. And then the protocol says that the private key will only be generated at a certain later point in time when the block ordering has been committed to. And the private key can be generated by a majority of the distributed key sets. So in this case, you could reuse the validators and say if 50% or 60% of the validators collaborate, they can produce the private key to later on reveal all the transactions that should go in this block. But also assuming that not more than certain threshold colludes, you wouldn't be able to reveal the transaction content beforehand. This is one way of doing it trustlessly. The other one that's been discussed is VDFs, so verifiable delay functions, where the assumption is you can encrypt your content before, and then it's just a matter of time until the content of your transaction will be revealed. There's no actual key that you have to reveal. It's just a matter of time. The fastest hardware on the planet cannot extract the thing that you use to hide your transaction intent faster than, let's say, 5 seconds. So basically, you would send your encrypted or pseudo-encrypted message to the miner. Within 5 seconds, they would have to commit to the ordering. And then it's kind of guaranteed that only afterwards they would have access to the content. And yet at the same time, there's no responsibility on you collaborating, the miner collaborating. It's kind of trustless in that everyone will be able to reveal the content of your transaction at some point in time.
So I don't want to say that we shouldn't explore any of these things, because I do think we should explore and experiment with all of them. But I do want to note that even with something like DKG or threshold encrypted beacon network, any of these kind of commit and reveal schemes at L1, you don't solve all of the problems. They're not kind of silver bullets. And specifically what I want to highlight in these systems is usually someone has access to information about the updated state of the chain first, or there's some way that you can play the game to get access incrementally faster than someone else. And with that information, you can act elsewhere in the world and make money through cross-chain MEV. So maybe, markets update on Ethereum, you get access to that information first, and it lets you act faster on a centralized exchange, or Optimism, or Binance Smart Chain, or Starkware, pick whatever preferred chain you have. And the existence of this MEV that is not just about a single domain, but between domains, is still a problem, even if you have this commit and reveal scheme at L1. So not to say we shouldn't explore those things. Those things are great. Flashbots funds research on those things. We're very interested in them, but just that we need solutions that take into account the entire crypto ecosystem and MEV that exists between systems instead of just one L1 itself.
Well, it's almost like that comment was planted to transition over into cross-chain discussions. So maybe we can talk about some cross-chain MEV strategies that are coming up right now. Tarun, do you want to take that one?
Yeah, sure. I think this idea that you can remove MEV completely is sort of a non sequitur. It's sort of in some ways, there's always uncertainty in transaction processing, and there's always some minimum amount of information that leaks. So, you might, with threshold encryption, be sort of moving, to Robert's point, you're just moving the MEV somewhere else. People will, while waiting for the transaction to be committed or revealed, go trade a derivative on another chain, cross chain, that basically extracts, maybe it doesn't extract the same amount of MEV, but still is able to extract, say, 90% of the same thing, depending on how it works. So I think we're going to see a lot more attacks that look like synthetics. A lot of the bridge hacks over the last year, especially the ones that had sort of a synthetic representation of a foreign asset. So like I start with ETH, I lock in a bridge contract, I go mint wormhole ETH on Solana. The idea that these two synthetic assets can deviate in price and liquidity, or they can't be redeemed one-to-one. I lock one ETH in this thing on my ETH representation on Solana is not worth one ETH anymore due to some sort of bug or issue in the system. I think those types of things that we've only kind of seen them used in these like bridge attacks because they're very high value honeypots, right? People have hundreds of millions of dollars in these bridge contracts. I think that these will generalize to the application level, and it'll be much harder to detect, or it'll take longer to detect kind of things where things that are on two sides of both chains are supposed to be the same, or at least up to some bound be roughly the same, but they deviate for a long enough time. And you can do that by sort of buying up block space on the cheaper network to cause the deviation to last for longer. And we've started to see some of this in Cosmos. But I think like we're going to probably see an increasing amount of this type of stuff that takes advantage of the fact that fees on one network are way cheaper than fees on another network. And so if two things are supposed to be the same, well, it costs you less on one to kind of force the price to not update. And yeah, like I said, I think in Cosmos, we've seen some of this. And I think as roll-up fees start to diverge more, we may also see things like this where, you know, people sort of don't kind of pay attention to some of these things, especially until the roll-ups are truly more decentralized at the sequencer level. So I think there's stuff like that is the lowest hanging fruit. There's obviously cross-chain sandwiching and things like that. I think the taking the existing MEV and just splaying it across chain is sort of the natural first things and that you've seen. But yeah, I think taking advantage of different fee structures will be the main kind of thing we start seeing a large amount of. And a lot of the bridge attacks arguably already do that.
Do you have any ideas? Oh, I'm sorry, I was going to ask you, Tarun, if you have any ideas for mitigating cross-chain MEV.
Yeah, again, like I said, I think your only goal should be to reduce the total amount of MEV. I don't think this concept of it being free or totally removable exists. There's always a cost to everything, whether it's the increased latency from your fair ordering solution or reduced security, whether there's a time value to that. It costs something to some users. I think the main thing that probably still hasn't been explored is really, there are two things. One is the granularity at which we define MEV. Right now we define MEV for Ethereum at the block level. You're entering an auction for buying a slot, a position in a block. But you could imagine MEV at the application level, where the application says we're willing to sell the rights to like some fraction of our transactions. And in order to even use the app, you have to bid. And that the auction has to finish before any processing within the application could happen. So in some ways, the applications could also try to extract some amount of MEV. And we've seen sort of attempts at this with like revenue sharing AMMs, where they return some of the MEV extracted to the user. But I wouldn't be totally surprised if we see designs that change sort of mempool structure to allow apps to say we're going to have auctions at the level of an app or a function call. And I actually think that would change it would make the MEV cross-chain MEV problem a lot more complicated, because now you have to bid on many function calls and you don't have enough time to actually solve that auction. So you'd kind of computationally hamper your adversary. And the other thing is designing better auctions, because like I think that if you have an auction that's aware of cross-chain MEV, like say your MEV auction was bidding on both sides at the same time. I think and in Cosmos you see a lot of that because the validator sets are kind of overlap a lot, so that people are trying to do that. But but that would be sort of those are the two main things I think that haven't been explored a lot.
It's interesting. I think we have started talking about some of the challenges that arise. One with designing MEV like aware projects, and then also especially in this cross-chain paradigm. So I think Felix, you had an interesting question about cross-chain sandwiching. Do you want
I just wanted to know, Tarun was mentioning cross-chain sandwiching. Just wanted to know if maybe you have an example of how concretely that would work.
Yeah, so I think in like Synapse version 0 or 1, the way you would go across the Synapse bridge is there would be Synapse ETH, let's call it Synapse ETH, and Synapse ETH on the other side. And you would sell through an AMM ETH to Synapse ETH, and then you would get one Synapse ETH on the other side, and then they would trade that to whatever, say Wormhole ETH. And there was a lot of sandwiching around those enter and exit transactions, which then led them to get rid of their AMM. So I mean, if you have an AMM at the bridge, there's a ton of weird little sandwiches you can take advantage of, because you still need to provide a slippage limit, and it's very likely, again, the synthetic asset doesn't track as tightly as you might think.
That's good. So maybe we'll take a pause here. I know there's a number of audience questions coming in. Also, we are a little bit over the hour mark, so if any of the guests need to drop off, understand. But would love to keep you on to answer a lot of these questions. We saw that Key has posted so many heroes in one call, so definitely a lot of just really great innovations happening and discussions happening in this conversation. Let's see. There was a question from HiFeb, who asked, if users create and typically pay for MEV, is there a way for users to capture this value that they're bleeding? Maybe Flashbots or someone else would like to.
Sure. I mean, so the reason that users currently leak MEV to search us is that user gives away their transaction for free, right? They just send it out to the public mempool, say, do whatever you want with it. Anyone can include this transaction. And this is actually where both 0x and CowSwap come in, and they put this model on its head, and they say, here, I'm the user, this is my transaction, this is my intent, what I want to do, but it's not a publishable transaction. It's just sort of a payload without my signature. And I want you to make me an offer, basically, sort of I'm abstracting in the case of CowSwap, because CowSwap has sort of auctions between different solvers in order to also fill the user. And then in 0x, it's more directly market makers bidding in order to be allowed to fill the user order. So in both cases, you have not the miner now in the middle of which transaction they want to include, which of course will favor the transaction that most exploits the user. In this case, the transaction that wins is picked by the user or by a smart contract, and it's a transaction that doesn't pay the miner the most or the searcher the most, but actually pays the user the most. And so this is kind of the transaction format that we need in order to mitigate MEV.
I think the protocol economics that we introduced with 0x in version 3 in 2019, I thought it was a really, really clever way of basically making the arbitrageurs that are engaging in these priority gas auctions pay either the protocol or it could be the user. And the way that it was done, and it had some trade-offs, but it was super interesting, I thought. And I'm actually surprised we haven't seen more teams exploring this approach, is that 0x protocol introduced a fee that was denominated in units of gas. And so if an arbitrager or multiple arbitrageurs kind of engage in a priority gas auction where they're bidding up the price of gas, they would also have to pay a protocol fee that scales linearly or proportionally with the gas price. And what this would do is it would, basically instead of having most of this MEV captured by the miner and the arbitrager, it would force, a portion of that kind of a portion of that arbitrage opportunity to be paid back to the protocol. And it could be, and the protocol could then in turn return that to the user if it wanted to. But so I guess more concretely, say if you are, Uniswap could introduce, for example, a gas denominated fee. And so if, these arbitrage bots or front runners are paying really, really high gas costs to take advantage of an arbitrage opportunity or to sandwich attack a transaction, then they would pay, approximately kind of half of that, half of what they would have spent on gas would instead go to the Uniswap pool. and that could be paid to like the LPs. I don't know if I explained that very clearly, but it was a way of basically turning priority gas auctions into a way of actually paying the protocol or the end user, the LP, and it also kind of introduced some developer experience trade-offs, but it was a way of kind of having MEV bots kind of paying users for that MEV, if that makes sense.
So it looks like Phil has a question as well. So it says, so if the problem is in part that the users are insufficiently knowledgeable, do block explorers like Etherscan almost have a moral imperative to make MEV more legible? And are there teams that you know of that are working on this? Does anyone have any feelings about this one?
Sorry, I just had to take my food, but I did want to respond to a point that Will made about sort of protocols that try to enforce anything based on gas price. So this may have worked in the past, but it's not really incentive compatible. I don't know if you already said this, but because I had to leave. So, but yeah, today it wouldn't work anymore because really you create, I mean, if you try to cut into the fee that's paid between a searcher and a miner, then they will just find a way to side channel you, and they will find another way to make that payment that's not in the transaction fee, but for example, in like a Coinbase reward or in a direct transfer or any other way. They can even send it to each other on PayPal, right? And so, yeah, systems like MEV has proven was one thing. Anything that can be exploited for profit will be exploited. And so it's important that these systems are really sort of designed in a very adversarial way, where we expect that sort of any edge will be ruthlessly exploited by the participants.
Yeah, that's actually exactly what happened. And kind of, so, the protocol was actually like, generating a good amount of fees from MEV bots. But then like Flashbots basically came in, and Flashbots kind of allows, network fees to be paid through side channel. EIP 1559 kind of changes it with like the base fee and the kind of priority fee a bit. But yeah, you're exactly right. Like if there's a way to side channel a payment or that's tied to gas price, like it's going to be absolutely used.
So I know we are running a bit over time with some folks having to drop off. So maybe we'll wrap up then with the last question of what are your thoughts on risks that MEV will pose to the Ethereum system if left unaddressed? I think Hasu had kind of mentioned it earlier on at the very beginning of this conversation. So maybe wrap up with those thoughts. And definitely seems like, I mean, this is definitely a very, very juicy topic. Just overall MEV discussions, we definitely have a lot to talk about here. So maybe this is a part one of a continued discussion, but there's definitely a lot of resources for those who are listening and want to continue digging into these topics. So yeah, how about wrap up with the last question of what risks does MEV pose to Ethereum if left unaddressed? Let's see, have I heard from...
Happy to take a stab if you want. I'm sorry. I thought maybe you'll call on someone else, but
no, I was going to call on a Robert. So yeah, you read my mind.
Amazing. So I think that MEV, if left unaddressed, can be centralizing. So if one block producer can make more money than other block producers can per unit of stake, then that is economically centralizing to the protocol over time. It lets large parties grow larger and larger, and at the limit, you may get one or a small set of block producers, unless you have equal and open access to MEV, regardless of the size of a validator or their sophistication. And I think also if you leave MEV on the table, you provide subsidies to actors that are interested in attacking the protocol too, that may have less, more scrupulous morals, let's say. So that's one thing, one risk to the ecosystem if MEV is left unaddressed. It could be centralizing. MEV also can be destabilizing. It can provide incentives for block producers to destabilize the chain, do things like roll back the chain to capture MEV rewards that existed in the past in what's called time-banded attacks. Finally, MEV has negative externalities on users. So we've talked a lot about slippage today. Haven't talked as much about the effects of spam if you have first come first serve on your chain, or spam if there's some sort of probabilistic execution that happens in the way that transactions make to the chain. But if you don't build things, your protocol in an MEV aware way, or your application in an MEV aware way, there can be a lot of negative externalities on users. And I'll leave you with that. So centralization, instability, and negative externalities.
All right, yeah, good summary, Bert. I'll pass it off to the other Robert.
No, I didn't have anything interesting to add.
Oh, no.
There are bigger experts here.
All right. In that case, let's just go around the table. Will, what about yourself? Any thoughts on this?
I don't have anything to add other, Bert, I think, really summed it up well. And yeah, Flashbots in general, I think like pretty much made the idea that MEV is like a massive and powerful centralizing force for blockchain networks, like really kind of made that like a mainstream understanding. And so definitely like commend the work the Flashbots team has been doing.
Sounds good. Then anyone left on the table who wants to add to Bert's answer?
I mean, I basically just wanted, it was completely correct and complete answer. I just want to basically summarize it that if left unattended, MEV is an existential risk to Ethereum. It basically risks of us not being able to build a better financial system or the internet of transaction that is superior to what we have today, with regulation, with limited access, with, some people would call it rigged. So I do think MEV is the most existential risk we have to building a better decentralized future.
Well,
I guess I think maybe I'm gonna be the only one who's saying I don't think it's always as horrible as people believe. There's sort of some natural sense in which like you can't really like remove it, and it does provide actually access to arbitrage for bootstrapping new apps where you would actually have trouble attracting liquidity or attracting sort of volume to a new system. You sort of do need these kinds of things to exist. Of course, the question is like, how do you make it sustainable? How can it fund other goods, perhaps, if implemented correctly? I think it's much more important to think about the design of how the capture and redistribution works very carefully and make sure that like optimizes sort of welfare of the network, rather than strictly like saying everything is shit and like we should just remove it and hope for the best. So I just generally think like a level of like maybe less like rancor about like how everything's going to blow up and die is maybe how I feel, because I think there's a lot of weird positive externalities that you find for certain types of actions in the system. Obviously, there's the ones that are deleterious. You don't need me to. You had a whole panel of people mainly saying that. So I would take the other side of this and say, I think it just teaches us that, hey, we actually designed a shitty system. Like maybe we should do something better.
yeah, for sure. So for those, I think a lot of you all were in attendance at MEV Day. So there was the dark room and the light room. So there's definitely the spectrum of how to view this topic. So there's the negative sides and positive sides. For those who are watching, definitely take a look through the YouTube videos. There's some really good content there that many of these guests have presented on deep dives into those topics. So lastly, just want to go around and say, are there any resources that you want to shout out, or how can viewers stay connected with you and your project? Maybe start off with Hasu.
Yeah, sure. So you can follow me on Twitter at HasuFL, and you can follow Flashbots and at flashbots.net.
Thank you. You want to go, Bert? Let's just go around this way.
Bert C. Miller on Twitter, Bert C. Miller on all other platforms, flashbots.net to learn more about Flashbots.
Sounds good. Tarun, you want to go?
Yeah, Tarun Chitra on Twitter, also Gauntlet Network on Twitter.
Sounds good. And then Felix, you shout
So
out.
yeah, you can follow CowSwap. We actually just today rebranded and have a unified branding now between the protocol and the UI. And so we're at CowSwap on Twitter. And yeah, that's where we post our content and keep you updated on progress.
Cool. Congrats. And then lastly, Rob and Will.
DumbBets1 on Twitter. You will mostly see me retweeting 0x stuff.
I'm going to ask you about that
But
handle.
we can chat, yeah.
Mhm. And
If you're
then-
watching this right now, then you're probably already,
That's
you
true.
know, plugged in. But yeah, definitely follow all the other panelists. They are the top MEV experts in the world, and super excited that we were able to have a conversation.
Yeah. Well, thanks again, everyone, and thanks for tuning in. See ya.
Thank you, Jessica.